let me introduce our panelists without any further ado. We have Henry Steele, who is a fund manager from Odey Asset Management. We have Philip Clegg, investment manager at Orion Mine Finance. Julian Treger, who is the CEO and executive director at Anglo Pacific. Carl Tricoli, who is the founder and managing partner at Denham Capital, and Hans-Arne Lorange, who is the head of metals and mining at Clarksons Plateau Securities. So, panelists, if you could take the stage, and if we could have a quick round of applause for our panelists. Fantastic. Well, welcome one and all. We're setting the scene of the conference with this panel. I just want to get your thoughts on how is the market looking right now and what we expect for the year ahead. Who wants to start us off? Carl.
All right. Is this on? Okay. Yeah. So good morning, everybody. So my perspective is obviously one from a private equity perspective, and then you can hear from the others. I think our perspective on the market right now is that we see a dearth of capital for development projects. That the public markets have been a bit shaky, although they seem to be improving a little bit. But for projects that need capital in order to bring them into production and develop, it seems like that has been difficult to get in the public markets. We see that probably continuing through this year. And so what we are seeing is more of a move to some private capital sources. We'll hear from Philip with Orion, in the same boat, and Julian as well. So that's a little bit of a perspective on sort
you
of
said
the
you
market.
said that there is some new money coming back in. Where's that coming from? Where are you seeing that?
We've seen on a very, very, very small basis some limited appetite for exploration stories, actually, at least in the Canadian market.
Hans-Arne, what's your take?
Well, as I told everyone in London, it's still a very, very difficult equity market to raise money for junior companies. Certainly it is my colleagues over here, the private equity funds, the Orions of the world, that are providing most of the risk capital as we see it today. The traditional sort of market, whatever it is in Canada or London or in ASX, it is extremely difficult to find people that are willing to take down equity in these markets. What we do see, there's plenty of credit money available, but it's so expensive, so it's really returning equity returns. And I think that's where we have a part of the problem. The credit money in a 2% treasury world is requiring 9 to 12%, which is really equity. So who is going to provide
Well, you
equity?
haven't heard what we need, so that's...
Well, you are sort of in the mid-10s, are you? Or higher? I think that's where the problem is. Everyone is looking for mid-10 and have first lien rights over assets, which is really the return of equity. I think that's one of the challenges we see.
Some of my colleagues, though, were over in Vancouver for a conference earlier this month or last month. The mood seemed to be very positive over there. They've come out of a bit of a slump. Are we seeing certain markets picking up over others, maybe?
I mean, maybe at the beginning of the year, because of gold, and Canada's very, gold specific, there was a bit of an upturn. But I think we are facing a situation where there's a secular trend, and particularly amongst the very largest money managers globally, to move away from mining. And the mining sector needs to address a lot of those concerns about relevance, and why people should continue to get exposure to the sector.
You say relevance. What do you mean by that?
Well, I think we're all used to photographs of mines cutting open the earth and diggers, whereas I think brands like Hermes don't show crocodiles getting skinned when they sell their handbags. And I think that we just need to show much more about what the end product means to consumers. 50% of the world's anti-cancer drugs have platinum in them, but that's not something that anybody really knows or understands widely. And those sorts of communications need to be made now urgently.
Go ahead.
Thanks, Carl. Yeah, I just think it depends on the situation. I mean, say that if you've got a plain vanilla situation, it's in a developed market, and it's in a structure that appeals to investors, you'll get something done. And for us, I mean, we invest right across the capital structure in debt, streaming, off-taking royalties, and in equity. And so on the debt side of things, I think it's actually become quite competitive. There's a number of private lenders out there right now, and in certain situations, the commercial banks will come in. On the streaming side of things, if you're in gold, it's actually pretty competitive. In the other base metals and so on and so forth, perhaps less so. Equity is just remaining very, very, very difficult.
I was going to respond when we actually had one of our colleagues in Vancouver last week, so and echoed the same sort of sentiment, which actually was the basis of the comment I made earlier, that we're seeing some interest, and this was actually in Vancouver specifically, for some quality exploration plays. But again, it's fairly limited, it's fairly small, but I think his comment was also that they were seeing some green shoots coming, at least on the exploration side, in Vancouver specifically.
Henry?
Yeah, I would also just add, from my perspective, it's pretty interesting that it's, I mean, for years now, we've seen kind of the majors dry up on growth. No shareholders of the majors have wanted any growth. And the main reason for that, there were two main reasons. One is obviously growth is just putting more supply into the market and killing price, but also obviously the experience at some of their major growth projects, across all the different major miners. And so what you've obviously had is you've had the majors derate substantially, and so they're all trading on kind of double-digit free cash flow yields, and everyone looks at them and says, oh, look, they're all very cheap, they're all value stocks. But without any growth, then naturally they will just trade, the dividend yield will kind of be their required rate of return as an equity holder. So it's kind of natural that you have this double-digit free cash flow yield kind of projected going forwards, even into a backwardated, backwardated forward pricing. So what from our perspective, what we very much want to see are the chief executives of these major miners actually taking on risk. I mean, they're paid to take on this risk. They've now sorted out the balance sheets. They've got the cost generally under control. They need to be taking this risk, and so obviously that there's risk that to their own business and their own personal reputation that's cost a lot of the jobs of previous chief executives of these large companies. But it's now come to a point where if you don't take this risk, which is a necessity as a chief executive to start building stuff, and it doesn't need to be in a commodity that whether it's Glencore in coal or Rio Tinto in iron ore, that you dominate in that commodity, but particularly in gold, for example, where more supply doesn't change the price. It makes complete sense for these guys to actually start taking on risk. And that's, when I say taking on risk, I mean balance sheet risk. I mean lending out their balance sheet to different projects. And that doesn't need to be directly through big growth projects and internal big growth projects. There are smarter ways one can do it. You have a junior, for example, that sits there as a listed equity, and you lend your balance sheet for them to raise project finance into the assets, and at the same time you maintain that junior's equity cushion. And you can, lots of different ways you can get royalties, kind of equity kickers, whatever you kind of want to kind of participate in that upside. But it's that it's that fear of taking on any risk, personal risk and company risk, that's caused the sector kind of very much a large lender in the industry has always been the majors, and particularly post financial crisis. Obviously, you kind of any banks lending in don't just want recourse into a kind of a greenfield project. They need to have an investment grade balance sheet to have recourse to. So it's very much a kind of, for me, it seems an obvious area for these majors to exploit, is to start lending their balance sheets in smarter ways where they can identify the risk, price the risk, and allocate the risk correctly. If they want to see that re-rating upwards, it's no good just maintaining status quo and effectively just being a beta company trading with the commodity price.
When you talk to the CEOs of the mining companies you're investing in or looking at, how receptive are they of that idea?
Yeah, so their growth, they say, hey, look, the industry is being starved of capital. Our sustaining capex been way lower than depreciation for the last kind of 8 years. We have a lot of catch up to be had. we can build a lot of our exploration doesn't need to be greenfield projects. It can be kind of brownfields. Find new resources, convert to reserves. That's the way that we can add the most value. And that's the same in the oil industry. It doesn't matter whether in our fund it's oil and mining and conventional generation kind of power. So we're always comparing across the different, all different commodities, and it's the same with oil. What you saw was these guys kind of starving assets of capital because, drilling out and having high confidence ounces or tons or whatever, 10, 12 years out wasn't adding any value to your business. It was just spending cash flow now, not adding. So obviously your reserve life was just falling over time. And now they're saying, now the market's starting to think about that more as reserve lives have got, 5, 6, 7 years. In total life, kind of dropped down from the 12 that they were maybe before that investors demanded. So they're saying, hey, look, I can get a higher, very low risk, kind of high confidence returns by just putting money into the ground in my current assets. And it's kind of maintenance. It's really just maintenance capex. It's going to be really increasing maintenance capex to kind of keep the assets kind of sustaining. It's not necessarily growth of new assets, and they just don't want to be taking on for their own personal risk. It's reputational risk. They don't want to be taking on. You build another Minas Rio, another Oyu Tolgoi, another Koniambo, whatever it is, and this thing blows out, and the shareholders are going to want your head again. So that's really kind of where it's got to go. Is Anglo a bit, as we're seeing Anglo do it a bit and allocate risk. They are doing it a bit more than the others. But we just haven't yet seen it. I think for me that's kind of where it needs to really be going. Kind of lending balance sheets, identifying risk, allocating risk properly. I mean, in particular, the last thing I'll say on this is, in the oil and gas industry, it's very much standard for during a construction period to allocate the risk, to give kind of turnkey guarantees to the EPCs. Or sorry, they give them to you as the constructor. But in the mining industry, we just don't see that. You kind of see it very commonly at particularly at the moment. So you've got Technip in Israel doing it. You've got Bechtel in the US. They're willing to give away their balance sheets, and so they suffer that cost and that time overrun risk. It's correctly priced risk. Why should a Rio Tinto or a Glencore be suffering that risk? They're not the correct owner of that risk. So you might pay a bit more up front, but it just gets people more comfortable that you are allocating that risk, correctly. And for me, it's something that hasn't necessarily been done historically in an optimal way, is that allocation. It's kind of risk allocation, risk identification, and risk pricing. So you actually need to kind of look at your risk-adjusted returns of things, rather than, what we saw in the industry was 2014-15. You saw everyone say, right, we want a 15% IRR. That was what everyone said, right? The industry hurdle rate was 15% IRR after Glencore came out of it. What did everyone do? They just changed price assumptions. They put in financial risk. You saw kind of, sale and lease back of desal plants. It's Spence, for example. You saw railway sale and lease back. So you just shoved in as much risk as you could to get this 15% IRR. But the reality was, on a risk-adjusted basis, it was actually a terrible IRR. Whereas people shy away from very low risk IRR projects, and they'll sell coal mining assets producing cash flow, and that they're all shoved through the same discount rate of these majors, and they'll sell these projects, these very low risk, high confidence cash flows, and reallocate to greenfield, high risk construction projects in emerging markets. So you just have this unappreciation of risk, really, is my perspective, is from the majors.
If I may. Just a really good point on risk here. I think that as an industry, actually, we're terrible at understanding risk. So, the classic in our industry is that every single gold project that you'll ever come across it's got a discount rate of 5%. How does that make sense for our industry? It doesn't make any sense at all. That is not a correct risk assumption.
Yeah, I think that what all of us are seeing, that all the 43-101 and York report is coming out with 8% or something like that calculation. And no one of the investors, at least all of the four guys on my left side here, is willing to invest on 8% IRR when you know what risks are involved. So I do believe that if you speak to Rio Tinto Venture, they have an internal sort of threshold for a project which is 29% IRR or something like that. And of course it's very difficult to compete with that sort of threshold when you have a professional organization that have a big portfolio of projects, and to be a junior and compete with that is challenging. So what you really need to do is to find organization like Denham or Julian and so on that have a staff that can bring more than money into the organization, and then you can find investors that piggyback on those. But I think that what the industry need is more sort of people that have a technical organization to support junior companies, because it is difficult to build an organization and take a project from greenfield into production. We've seen it again and again. It's cost overruns, it's delays, it is challenging. So money with some skills, not just money, is probably what we need.
But I think for portfolio, for royalty and streaming companies, actually, for precious streams, they will do it at 3 to 5%. And we would actually do deals at 8 or 9% in the right jurisdiction. So I do think the risk of the actual investment, the profile of that could lead to returns at or below the 8% discount rate. I just think for equity, clearly, it's got to be much higher.
Henry mentioned the idea of majors teaming up with juniors to work on maybe some sort of starter projects and then with expansion potential. Can our panel think of some good examples, some recent examples where a major has done that and partnered with a junior and
Well, I think South 32 did a couple of those sort of partnerships on development deals, some of which they ended up acquiring all of in due course. But that's a model which I think they are pursuing.
Hans?
Yeah, I think we have seen that in Trilogy with South 32. I think we've seen it in Sol Gold in Ecuador with both Newcrest and BHP investing. So I think there is examples of that, but it is a very few times we've seen it. When we have clients that is sort of we present them to the majors, it is a challenge to get majors interested in junior companies.
Yeah, this is all part of the same theme, I think, which is one of the things we haven't talked about yet that impacts capital formation for these junior companies is this transition from active to passive management. And perhaps Hans and Henry can comment more on this, but particularly it hits the juniors particularly hard as money has really left the sort of long-only, resource-oriented funds, and as the market generally moves to more passive investments, those by definition go to the larger companies, and it really leaves a hole for the junior miners. And so whether it's that needs to be filled, and it needs to be filled by those of us on the private side, it needs to be filled by the majors. All of these are a little bit still in their nascent form, but I think as we look out over the next 5 years or the next decade, I think we will see a transition in how capital is formed for junior companies that are the growth companies, but this capital has to come from all these sources. But again, Henry and Hans, you might comment more on this shift to passive from active and its impact here.
Yeah, I would just say from my perspective, it's very much our belief that we need to have edge. What is our edge? Very much we don't. For example, we don't take any commodity price risk in the fund. We say, right, what are we sitting in Mayfair have any kind of view on where the copper price is going to go tomorrow or in the next 6 months? So we try and take that risk out, and it's the same with exploration and development assets. We're the alignment of interest between us and an exploration promoter is very misaligned. They want to get their equity price up to dilute themselves as little as possible. So us kind of sitting in Mayfair, unless we spend a lot of time doing due diligence on those assets and get some sort of edge on that asset, and probably that asset, if we are interested in it, there's going to be a lot of other people, and it's going to be winner's curse effectively. Whoever's the winner into that asset, unless there's kind of some dearth of capital going into it, which is exactly what you're saying, and I absolutely agree with. So I'd say, look, it's not really for public markets. I think it's right where the market's gone that active money has left the exploration area, because it's absolutely not right for me to be investing in a project which I haven't even been to probably, or had spent however much, hundreds of thousands of dollars having reviewed by all the right technical people, and I won't be able to lend in any sort of bring any sort of advantage as an investor, whereas the private equity guys, the majors, they have all these teams, this expertise, they're ready to go. So I think for me it's absolutely right that you should have different investors for different types of investments. and in my opinion, it's not really right for us to be investing in that space. Kind of stick to what you know, really.
What is your typical investment approach in the mining sector?
Yeah, so we're generally looking for kind of larger market cap stuff. We need it quite liquid. We need to have a commodity we can hedge out generally, and generally a producing asset. They're probably the triggers on what we're looking for. It can be in some exceptional cases if the return profile's so attractive and it's a producer, it's just very low risk and it's very, very, very attractive returns. We can go for quite a liquid stuff, but when I say that, I still mean a kind of above 100 million market cap, 200 million market cap.
Yeah, I thought that was fascinating, Henry. It's in the mining sector, it's very unusual not to take commodity price risk. For me, of all of the things you're investing in, it's the commodity price. You could get everything wrong in an investment, but if you get the commodity call right, you will win. So I just thought it was quite interesting.
Or vice versa.
Yeah.
Or vice versa. Obviously, we as a private equity person, we spend months doing due diligence, looking at all sorts of things, including commodity price, including management team, including the quality of the asset, including the geopolitical risk. But ultimately, if you get the commodity right, you will win.
And on that subject, which commodity do you like the look of right now as we go into 2020?
Quite like nickel at the moment. It did pretty well in the second half of last year. A bit of concern about the amount of material that's coming out of Indonesia, but I think over the next sort of 3 to 4 years, the incentive price of nickel for HPAL projects in particular is way, way, way in excess of where we are today. And so I think that there's a good future for nickel.
Have they got that HPAL plant up and running yet?
Who's they?
The Changchan, which was it called? I can't remember. In
Changchan.
Indonesia.
I think they're building it right now, but they put in RKF lines every single month, line after line after line. That's the concern I was making reference to.
Yeah, I've been saying this for years. It hasn't happened yet, but I think copper will be a great winner in due course. I think the riots in Chile were extremely positive for copper because that means that Codelco, which is the biggest copper producer in the world, is not going to have enough money to replace its current production, and they're going to decline. And then you've obviously got the whole green movement, which is very bullish for copper. So I don't expect that to happen this year, but we don't invest for 6 months. We're not traders, so it's a 3 to 5 year view, and I'm convinced that is definitely going to be a beneficiary under any scenario.
I would agree with that. We are constructive on copper, although I think the more general answer to that question for us is we're a little bit commodity agnostic. I'll differ just ever so slightly with Philip on, we sort of look at these markets and say, we're not going to be great predictors of where the prices go, and they're just going to go through cycles. And so we tend to focus on the margins and take the point of view that if you have a good enough margin, then you can sort of survive the good times or survive the bad times and exploit the good times. And so we tend to focus much more on the fundamentals and the ultimate margin in that project, which many times obviously just goes to grade, and focus on that more. But we're very constructive for the reasons that Julian outlined on copper, and probably base metals more generally. I would say, and this probably leads into a whole other discussion. We've been very active on the metallurgical coal side. We're actually very constructive on metallurgical coal. We have a very large project in the Bowen Basin in Queensland. But what has been interesting, someone mentioned sort of the ESG issues, and particularly in our LP base, the complete inability to distinguish between metallurgical coal and thermal coal. And so there's an enormous sort of backlash against coal generally, which impacts not only thermal coal but even metallurgical coal as people, so we're sort of evaluating our view to that going forward. But from a pure investor standpoint, we're actually pretty constructive on the metallurgical coal space.
Yeah, I think you have a very good point when it comes to what are the LPs looking at and what are they allowed people to invest in. We also see a lot of good returns in met coal. It is definitively one of the commodities that looks fantastic, but I'm not sure I would buy met coal stocks because stock market is looking different than what the margins are in the industry, because a lot of the funds are, as you say, not allowed to invest in fossil energy, and coal and met coal is going in there, oil and gas is going in there. These companies, whatever it is, Exxon and BPs and Shell of the world, are doing fantastic margins, but the investor universe for the stocks are decreasing and decreasing. And you know, if Philip goes and say, I want to buy a coal asset, probably his LPs say, well, it's not ticking the box. And I think that's where there is a big difference from the commodity to what the equity investors are looking at. Equity are driven by ESG, and that wave is going to be larger and larger, in my view. And I think that that's one of the challenges. It's a disconnect between the underlying commodity and the demand for it, and what the equity market appreciates maybe for the next 12 months.
Yeah, I think there's a trend to de-risking or derating publicly traded mining companies, even if they're very profitable, which I think is unfortunate, but it will create opportunities for some.
Yeah, I think that is the theme as it comes to LPs, is ESG. So for us, as you know, we've got 6 billion under management at the moment. So there's a huge amount of capital, and all it takes is for one of our large LPs to have a problem with something, and that will infiltrate the entire LP base. So for example, if you bring in, you know, a Californian LP and they do not like thermal coal, that's it. You're not investing in thermal coal. That's actually always been the case for us. But ESG is the new theme. And so, you know, for us as an organization, it is top of the list. For every single investment that we make, ESG is top of the list. It's the most important thing that we look at. And so much so now that one of our requirements as an investor is that the companies in which we invest have to aspire to apply the IFC performance standards in everything they do. And in fact, one of the investment committee members of Orion is a lady by the name of Robin Weissman, who actually wrote the Equator Principles. It's become so important to our LPs that we must follow that. We don't have to apply them from the outset, but you must aspire to apply them.
This comes back really to what Julian was mentioning at the beginning about the industry needing to rebrand, and rather than showing a big open cast pit, maybe show a mobile phone or a medical device or an EV or something.
Yeah, I think, I don't know if they teach at mining school communication skills and PR, but that is turning to be one of the most important skills for the sector. And I think the sector is going to move from being much more B2B to B2C, and they've got to engage with the ultimate consumers in a meaningful fashion which provides trust and understanding. And at the moment, we're singularly bad at doing that. And the big consumer brands really are starting to put pressure on the miners to provide that transparency, and are starting to do funny things. Like I heard of a jewelry business that's now said they won't buy gold from big mining companies. They're going to buy from artisanal miners, who actually have terrible, health and safety track record, deal with dangerous materials, but the perception is that they are like, a delicious coffee brand in Tanzania or something from an obscure plantation, whereas that's not the reality, and the sector needs to explain why, they've reduced the amounts of deaths and injuries significantly over the past couple of years, why they can be trusted.
Kind of locally sourced mercury. Do we have any questions for our panel at this stage? Questions? Stick a hand up. We'll get a microphone to you. We haven't talked about sort of China and sort of global events at the moment, how that's impacting the industry. There's a couple of things going on over there. Trade war may be getting slightly better, but then this nasty virus. Is that having any impact on how we see the year ahead panning out, do we think?
I mean, obviously, there are issues, but perhaps the Chinese will do a lot of stimulus to counter that as.
I think your microphone's just cut out there. Yeah, no, that's a very good point, because if the disease can be fixed fairly soon, which people think it probably will, then we would expect a lot of stimulus, wouldn't we?
I think that's right, but who knows? Nobody knows.
No, but I think that in general, unpredictability is risk-off amongst investors. So I think that crisis like this coronavirus or thing that is complete unpredictable is negative for junior companies or mining companies looking for capital, because people are more careful, and they also make a question about the growth in China. Even though we could see stimuli, it is an unpredictable, and it's an out of also the maths how this will work. So again, it's risk off, which is negative in general.
What impact will it have on the gold price, though, do we think? I mean, that and so many juniors are in the gold space.
Yeah, I mean, it's quite interesting, because you'd think it would be bullish for the gold price, but then when you get the markets all selling off, everything gets sold, so gold gets caught up on that too. So, it's very, very difficult to say, and that's, I suppose, goes back to my comments earlier that if you believe commodity prices follow a random walk, then why take a punt on the commodity price? So, it should be structurally good for gold, you'd imagine, but, who knows, if we have indiscriminate selling, then the gold price falls as well.
Absolutely. So looking ahead at 2020, what are the big themes that investors should be looking for? Where are the opportunities lie? We've talked a lot about some of the risks and some of the things that are holding the industry back. Where are the green shoots?
I think the US election. If we have a situation where you've got a Sanders or someone that comes in, that will surely be the end of the trade war, and that will be obviously very, very constructive for base metals and other commodities.
I also think if Trump is re-elected, he's definitely going to go for this $500 billion infrastructure package, which would start hopefully being implemented next year, but will kick in the subsequent years. So that could be a black swan event, which could be unexpectedly positive for base material, or bulks, actually.
What sort of size of deal are we talking about now in infrastructure spending?
I think they were talking about $400-500 billion, what I saw. And I think that probably has bipartisan support. So it is something he will try and undertake in the second term, if he has one.
As we look out for the next year, we actually see this as a very opportune time for investment. Because again, some of the things that we're talking about, electrification and those things, which were very constructive over the medium term, which that probably means 3 to 5 years, those things still haven't kind of worked their way back into the fundamental commodity prices. That combined with the fact of a dearth of capital. So as we look out on 2020, we actually see this as a time of great opportunity for us to actually put money to work. I think literally over the last probably 6 months, maybe the last 12 months, but certainly the last 6 months, we have seen a pretty dramatic increase just in the opportunity set, with, again, because there's no capital, et cetera. So we actually see this, we have a longer term perspective, so we see this as a time to really be sowing seeds.
Private equity typically does well when the markets are down a bit. So how long have you got to allocate your money, do you think, before people realize that maybe things aren't as bad as they seem?
I think there's a good couple of years. I think when we sort of look at fundamentals, I think the things that everyone talked about earlier, the things that Henry talked about in terms of majors and their not wanting to spend money on growth and those sorts of things, this has been going on for almost a decade. And so this is all going to catch up on the supply side. And it hasn't worked its way necessarily into prices as of yet, but it will. And so, Yeah, so we see this as a, in a 5-year time horizon, when we're investing now, then, the next 3 to 5 years is a time when we should reap those rewards.
Yeah, I mean, Julian, I think, mentioned Codelco and copper, and there potentially being a supply side crunch on there. What other commodities are we seeing that opportunity, the supply side squeeze emerging?
I would just say, from my perspective, what's pretty interesting is even within commodities. I mean, the naive investor looks at a commodity as a commodity, but obviously product differentials, are huge. And so I think like the continuing theme on ESG is going to, whether it's in iron ore differentials and iron ore qualities or bauxite or whatever the commodity, even very much in oil, for example, at the moment with IMO, there are huge benefits to be had in where you are within that commodity. If you are higher grade stuff and you're not being priced in that manner, and you can get into that equity and you're paying pretty standard, where the product differentials are very small. If we see that blow out, which we for the obvious reasons, then there's a lot of value to be had there for me, from my perspective. So not really necessarily a commodity view, a commodity price view, but kind of a differential view on that.
I think that's right. I think actually size matters at the moment. I mean, you see these nil premium mergers that are going on into the gold space, and I think the most recent one was Equinox Leargold. If you look at the re-rate of those stocks as a consequence of a nil premium merger, it's astonishing. It's 30% up.
So I think the commodity cost profile is changing because it's moving into different dimensions, more based upon quality than just on price. And I think that is going to be a big development that we're going to see in the whole sector. The decommoditization of commodities is something which we will notice accelerating over the next couple of years because of things like ESG and carbon footprint. And I think one of the other commodities which is going to be scarce, just going back to Carl's theme, is going to be met coal, where I'm aware that a lot of steel companies are getting very concerned about security of supply for met coal to be used with iron ore, and there really isn't much new met coal development globally because it's so difficult.
When you talk about the decommoditization of commodities, that's what you're saying. It should become more of a sort of a part of someone's lifestyle brand and things like that. So
No, I think the comment was really that even within iron ore, if you're buying 58% Fe content versus 70% Fe content, there's much less emissions comes from the 70% because you need less and all the other benefits of that. So it's just breaking down the commodities on with oil. Is it heavy? Is it light? Is it sweet? Is it sour? Within what's the calorific value of the coal? All those kind of questions. That the traders have been all over for 30 years, but no one's really cared and no one's really priced properly, and that's obviously where the traders have made a lot of money. So it's kind of breaking down those commodities into their own specific kind of segments, and then pricing that accordingly. So much more focus on kind of value, the classic stuff in marketing, value in use, next best alternative, and on value in use when you're properly pricing all the externalities and the negative externalities in that, which now are coming in and actually being priced properly in the EU with carbon pricing, or in China's enforcing it. So I think it's kind of much more kind of the breakdown of a commodity, whether you call it oil or whether you call it thermal coal or whether you call it iron ore, whatever it is, kind of breaking that down into its different kind of segments.
So I think cost curves will move from being in 2 dimensions into 3 or 4 dimensions. And you have to look at it in a much more sophisticated fashion.
And looking at how those commodities fit within the general theme of decarbonisation and moving to a sort of
So what's pretty interesting about it, it was a lot of bigger kind of equity theme in the iron ore space, whatever it was, kind of 2 years ago, was the huge differential of 58 to 62% iron ore, and it was the FMG versus kind of the Rios and the BHPs. The question was, is it structural or is it cyclical? And obviously, if you spoke to Rio and BHP, it was structural, and if you spoke to FMG, it was cyclical. And what we then saw was obviously the knockout of the 58% in Brazil, and that then caused the differentials to then squeeze. So when we see a lot of that lower grade stuff coming back online, which we should naturally see when a lot of those mines that have been turned off come back online, we should see that differential break out. So we'll see the discount of 58% to 62 to 65. That should increase quite substantially. And obviously, the higher the met, if we are bullish on met coal, if you have a view bullish on met coal, again for for obvious reasons, you should then see kind of that differential break out, to be wider. So there are lots of reasons, kind of where you're not paying for it today. The differential is very thin today. when you're not paying for it today, it's a great option to be buying if you're not having to pay up for that option, because from a risk asymmetry point of view, it's only upside. So, I think for the next year, for structural reasons, forget even all the ESG stuff, just for structural reasons on the supply side, we should see that differential breakout. But then on the demand side, I imagine, for all the obvious reasons that stuff's coming, the regulations that are coming through, we will also see kind of a demand and supply kind of, perfectly kind of create that breakout.
Right.
The thing I say on that is that from an ESG perspective, or where there's an angle with a particular commodity whereby it can be deemed green, the amount of money out there is actually quite impressive, particularly in Australia actually, but also in the US. So most of our LPs are in the US, and we offer them co-investment rights. And if we're doing a deal where there is some green angle, the level of co-investment interest is huge, markedly more than for something like gold.
So the mining industry needs to be rebranding and becoming the green industry.
We will never win that battle. We will never win it. I'll tell you why. Because the NGOs can say what they like. They can make things up, but we tell the truth.
But you have examples, for example, in the diamonds and gemstones industry, where they have been better at branding the companies. People like Gemfields, it's all about, we're sort of sourcing, we know where it comes from, we're tracking it.
I think that is an important piece of it. Where do supply chain come from and so on? And I think that the mining industry will see that much more coming now in the car manufacturers. They're really doing their due diligence. Where do the material come from, and so on. So I think that's a big change, and maybe you can call it greenwashing. Maybe it's serious, but where things comes from, how it's been mined, no bribery, no children, no pollution, and so on, will be more and more important. And I think it's all go back to what Julian said. We have to tell the people what are the end product we deliver, not sort of show them this big, bad, open pit that looks like hell, or underground miners that are dirty and looks bad. We need to focus on what are the products and what do the products that the mining industry deliver. What is that sort of gaining for the society? And then we have to be better on ESG. I mean, not sort of greenwashing, but being better.
Fantastic. Well, I think that's probably a good place to end it. If you want to ask any of our panelists a question, please do grab them outside over a coffee. But can I have a big round of applause for our opening panel?